Hi everyone, and welcome to a new video series about credit scores. I needed a break from my John and Jane videos that I've been making as I try and get those caught up. And credit scores and education is something that I find extremely motivating, and so I decided to make a series going through some pretty in-depth stuff. Hopefully, you'll find it pretty interesting. But I've always big on trying to, help someone understand why they should care about something. Someone will tell you about your credit score and say that their credit score is some number, and it just irks me. And the reason why is because don't tell them what your score is. Just tell them why they should care about what a score is, and then focus more on the behaviors that actually help someone get to a good score rather than just saying this is my score and tying it to your self-worth or something like that. So anyway, this will be probably a good, I'm guessing, at least 8-part series as we dig into kind of the nitty-gritty of credit scores. And my goal is to simplify, but it's at the same time not simplify it in a way that I would say presents credit scores in a false way. A lot of times people will try and do things to simplify something that they find complicated, and it's not to, it's not to give them tips and tricks to really help them understand it. It's really just because they will go, well, here's just a really easy way for me to tell you about something that's complicated, and now we can move on to the next subject. Whereas I prefer, here's something that's complicated. Let's break it down to concepts that are easy, but at the same time understand that there's nuance related to some of these easier concepts. Hopefully I can provide a couple examples as we go through this, because I know that probably wasn't entirely clear. But so part one, what is a credit score for and why should I care? So what motivated me to start this was that, between YouTube and TikTok, there is just a ton of here's how to hack your credit score, ways to instantly boost your credit score, how to fix something, 5-minute fix, 20-minute fix, you name it, there's a video out there for it. And of course, they're going to name it these outlandish things to try and catch people's attention because everyone wants a quick fix nowadays. It's not just millennials, it's not just Gen Z. Basically, everyone wants things done faster, and if they don't have to put in the work in order to get things better or repair credit. So really the idea here is be careful who you listen to. When it sounds too good to be true, it's because it likely is. And on the right hand side of the screen, the names that you see there, those are actual screenshots from YouTube videos. You can see 2.3 million views on one, 620,000 on another, and 901,000 on the other. And just imagine the number of people that are watching these videos and then making assumptions that they should be able to fix things really quickly. Now, oftentimes in these videos, they're stretching the truth, right? They're not saying that you can fix your credit score in 5 minutes, but they're saying watch this 5-minute video and I'll help you fix your credit score. So it's just misleading more than anything. But if where someone wants to charge you, so it's bad enough that these videos exist, but then if you have someone who goes, pay me money and I will be able to help you rebuild or reestablish credit, that is just a huge red flag. Don't do it. Especially if you're just establishing credit, there's plenty of ways to easily establish credit. And, that third bullet point might sound like something that, like, oh, come on, like, there can't really be people that charge to do this. We recently had a member of ours at work that paid $1,000 to meet with the Credit Brothers off of TikTok, and get a personal coaching session on how to reestablish credit and to do it as fast as possible. And I believe it was because the member wanted to buy a home as quickly as he could. And frankly, he would have been better off saving the $1,000 coming and talking to us. We would have given him coaching for free. But the problem is that a lot of times the information that we're giving isn't sexy enough, right? It's not fast enough. And so that in and of itself is a problem, is that we're trying to present the truth, but oftentimes the truth isn't sexy. So, as we're going through these slides, I want you to be thinking of this question. Are you able to articulate what a credit score means, and do you know why you should care? Okay, so instead of just saying a seven, I have a 750 credit score, so I have good credit. Like we need to do more about what is the purpose or the point of saying I have a 750 credit score. Because honestly, unless you have you're in my position as the director of underwriting, and I'm looking at a rate sheet, I am simply using that score to assign an interest rate. So when someone says that, hey, I have a great score and it's an 840, well, guess what? You get the same interest rate as someone who has a 740 at the institution that I work at. And it's going to vary between institutions and possibly between loan products. But even the fintechs that rely on other aspects of technology, they still use a score for assigning interest rates. And we'll get more into why that is, or what the purpose is behind that. But I do want to make a point here about the 2 bullet points that I have. I have had people tell me that they have a great score, and they are basically taking that and conflating it with the idea that I'm a good person, right? And I just want to make it 100% clear. You can have a great credit score and still be a jerk. Like it really is that simple. But the saddest ones that I see are the people that have low or no credit score. And so they will conflate that with being a bad person, right? The person comes in, we talk to them, and they kind of, they look down at the ground instead of looking at the eyes. There's shame in there. And I've had people before where I will talk to them and go, look, like, you had one collection for $78. Get over it. You don't have bad credit. You just don't have credit. So this whole idea of conflating your self-worth, with what your credit score is, just really take the time to not simplify you as an individual to whatever your score shows, because it's not a good indicator. So, what is a credit score intended to do? So, I want to start with 3 things that I would say I commonly hear, and there's going to be some truth inside these things that we commonly hear, but this is where I got into at the beginning of the video, talking about that we need more nuance when it comes to, breaking these subjects down further, so that it actually makes sense, because people don't dive deep enough into these answers. They just get the surface level answer that they want to hear, and then they don't go into, okay, well, what are the other things that might not be as simple as this canned, 1 or 2 sentence response. So first thing I commonly hear is credit scores tell us whether or not someone is risky to lend to. Consumers with good credit scores are more creditworthy and therefore more likely to be approved for loans than borrowers with bad credit scores. And 3, credit scores are the main thing financial institutions use to determine if someone is approved or denied for a loan. So, starting with number 1, credit scores tell us whether or not someone is risky to lend to. That has nothing to do with telling us if someone is risky to lend to. Okay? Now, is there a correlation between someone that has a good credit score paying on their loans and a person with a low credit score maybe not paying very well on their loans? Sure, I'm not going to dispute that at all. But a credit score does not tell me anything about risk. A credit score is simply there to help us price the interest rate, which, yes, is a function of risk, right? We're charging higher interest rates to borrowers with that present higher risk profiles. It just so happens that the lower your score goes, the higher risk you likely are. But we have members at our work with credit scores that are we're talking even in the 400 range. But the thing is that they always pay us on time, right? Now, yes, we are talking about the outlier of the group, and that's why a lot of institutions have used credit scores in the way that they have, is that they were able to say credit score is low, therefore risk is high. But for us, the way, at least the way that I see it, is that if I have a relationship with someone and they know that I'm the only one that's willing to help them, then that person in some cases can pay better than even borrowers that have 680 credit scores that miss payments every now and then, right? And the other thing too is that scores are only negatively impacted after 30 days of being delinquent. So you can actually have someone who's consistently paying on time with a low credit score because maybe something that they did in the past, and then have someone who's consistently paying late but is always paying before 30 days, and they're going to be charged late fees, but it's not going to show up as a late payment on the credit report. So again, the score can still be good even if the behaviors that they're demonstrating isn't. So a good example would be a credit score for a 750, or a credit score of 750 for a borrower who's 25 years old is not the same as someone who's 50 years old with the same score. Okay, credit profiles, thick, thin, and average or normal files. You know, I'm more willing to be lenient on the loan for typically that borrower who's 50 years old who has a history of paying on autos than I am for a 25-year-old who has no history of paying on autos, but has the same score. So credit scores are really just using historical and current behavior to predict where the finances of the person are going in the future. Okay, so the historical and current behavior translate into, you know, activity on trade lines, includes late payment, balances carried, and things like that. So that's part of the reason why I talk more about the behavior of the borrower than I do about the balances of the borrower, or you know, things like that, because it's the spending habits and vices and different things like that that are going to play into the credit score, and that's assuming that it even reports to credit. I'm going to be starting a whole different video series on some of these online payday lenders that are just predatory as all can be. I mean, you think that a interest rate of 25-30% is bad on a credit card. You know, I'm going to blow some people's minds when I show you guys what is available online, and is extremely unregulated. So anyway, I would say that a consumer's current habits can tell us a lot more about where they're going, because the score really only tells me where they've been. Okay, so that's going to have more to do with a credit score that is on the rise. Could be someone who is improving their habits and their financial situation, whereas someone that is a credit score that is declining is telling me that that person is headed downhill quickly. So myth number 2, so consumers with good credit scores are more creditworthy and therefore more likely to be approved for loans than borrowers with bad credit. Yes, for most financial institutions, this is true. I would say that the average credit model used just focuses heavily on score, and that just again has more to do with correlation and simplicity, and also in many ways automation. So automation is an easy way for them to go, hey, we're going to take these outliers, let's forget about them. That requires human processing to be able to discern the difference between two borrowers who have 500 credit scores, but maybe one does pay well. Well, if they still have a 500 credit score, they still have a bunch of other negative items on there. So for most large institutions, they're doing things like making cutoffs, like having a 680 credit score or higher. It's just easier for them to be able to do that. And then when they do take losses, they build it into their risk model and accept those losses as they come. So borrowers with good credit will always have access to more options for credit. But that also means that they have the potential to overextend themselves, right? So in 2008, I use this example a lot. It was not poor people who did not have access to credit that lost everything. Now, I know that there'll be some people that'll probably say in the comments, that I'm overgeneralizing, but really the people that caused the biggest problem in 2008 were those who actually overextended themselves by accessing as much credit as they could, and when the time came that they lost their job, they couldn't pay for their boat, they couldn't pay for their RV, they couldn't pay for their jet skis, and so they started handing all these things back to the bank. They couldn't pay for their second home or their third home, but the thing is that it required credit to get that. In some cases, it should have been more than what they had. But even more nowadays, you are not getting a mortgage the same way that you could pre 2008. So things have tightened with credit, and that's why it's the borrowers who, the fall from the top is definitely a lot farther than if you never got to the top, right? So a 780 credit score, they have a long ways that they can fall, and a lot of times it's going to be caused by life events such as divorce, other things, stress levels. There's all kinds of things that can make people act irrationally or exhibit behaviors that they would otherwise not normally do. And then borrowers with poor credit scores, a lot of times, and I mentioned this before, can have a low score as a result of just not having history. So the thing is that if you don't have access to credit, you're applying for credit, you can't get credit because you don't have credit. It's kind of it's a cycle, right? Like until someone helps you get out of that, or until you get a store card. But even once you get a store card, if you're starting to carry balances on it, it may be that you can have access to credit and then be your own worst enemy, even though you really don't have much debt. You just have bad information that you're acting on. And then for myth number 3, so credit scores are the main thing financial institutions use. I probably addressed this a little bit in the previous question, but they do rely more heavily on credit score for decisioning a loan. And again, it's a correlation thing, right? The higher your score is, the better chance the loan performs. You build in some losses into there, and it's a lot easier than saying, okay, let's take these credit scores that are maybe not so great, and separate out how many of these folks are people who are trying to turn the situation around and have the ability to pay well, versus the people that maybe they're utilizing these debts and they haven't hit rock bottom yet. The ratio is not going to be nearly as successful on that end of the credit spectrum as it is on the over 680 end of the credit spectrum. So financial institutions can set a floor credit score. Like I said, a lot of times you'll see where they'll set like a 680, and it may not even be like a truly official rule, but you'll notice that approvals for things get much more difficult to find under certain credit scores. Financial institutions use a credit score for determining parameters on the loans as well. So when you're looking at a credit score and what it's intended to do, financial institutions are saying, okay, for an auto loan, what loan to value am I willing to go up to? That is based on what your credit score is. A lot of times. How much unsecured debt am I willing to give this person? That's going to be a function of your credit score. So while someone may have employment, good payment history, they're not just going to give someone $50,000 of unsecured debt when they make $3,000 a month. But they may be willing to extend more to someone who's exhibited good habits over time, versus someone who is in the same position but maybe doesn't have a history. Where they're going to issue that person the minimum amount, or in some cases, none at all, because they don't have enough about that person's behavior to figure out whether or not they're going to get paid back or not. So, what is the purpose of a credit score? I like to use this hypothetical scenario a lot because I just think it's an easy one to understand. So, 2 borrowers come into the local financial institution and are looking to purchase a new vehicle for $30,000. Both people share the same characteristics: age, down payment, credit score, length of employment, etc. The only difference is that one borrower is male and the other is female. So the loan officer in this case is currently going through a bitter divorce and is frustrated by women. So what will the outcome be in a scenario where credit scores don't exist? Is it possible that we could see that loan officer assigning an interest rate to the female that is higher than the rate that they assign to the male? I think that we can all probably say yes, that if that loan officer has the ability to assign interest rates and there is no model that they have to follow for doing that, that human bias can come into play. And so bias leads to different results for different people. And that is essentially what a credit score was intended to solve, is to try and remove as much bias as possible, because when it comes to fair lending, bias is definitely going to be the biggest culprit, and responsible for a lot of the problems of maybe certain groups not having access to credit, and that we'll see as we kind of look at the history of where credit models came from. But what will the outcome be in a scenario where credit scores do exist? The loan officer will be required to assign both borrowers the same interest rate, because otherwise it would be a fair lending violation. Now, someone could make the argument and say, well, but what if that loan officer says then they want to deny, the woman's loan request? My response to that is that is the reason why we separate underwriting responsibilities from the lenders, so that someone who is doing the loan is also not underwriting their own loan, because you're taking someone who is going to be potentially biased and sending it back to someone who's in underwriting. And as an underwriter, my job is to be as unbiased as I possibly can. I look for inconsistencies in applications, and frankly, that's all I care about, right? I'm not looking at these other items trying to and hopefully, I guess you could even make the argument, what if I'm going through a bitter divorce, in addition to the loan officer? But the idea being that I see applications all day long, and I have to justify that if I'm going to deny something, and I would approve the similar app, and the only difference is one person is male and one person is female, that is not going to go very well with a regulator. That's not going to go very well with an auditor. So you have to actually be able to justify why you made the decision that you did. And so if I have two of the apps that are basically identical, it's definitely not going to be for credit reasons. It's definitely not going to be for employment reasons. Maybe they want to buy two different cars and one car has 200,000 miles on it. Well, now we're talking. I can actually deny an application because I don't like the collateral. But I need to be consistent in the way that I apply my decisions. So I apologize. I forgot that this screen, there was some stuff that was in black. That's why the words look funny. But when it comes to credit scores, it's just as important to know what a credit score and what a credit report doesn't do. And a credit report does not know your race, does not know your ethnicity, does not know your gender, and does not know your religion. Okay, a credit report is basically going to look at only things that can be objectively measured, and that is where the score comes into play. So what did we do before credit scores were developed? This was a pretty interesting dig that I did here, because there was actually a lot of stuff that I learned from doing this research. And a lot of it's stuff that you can imagine, makes sense that it would take place. But there's some things in here that I think should surprise, everyone. So before scores existed, merchants were known for interviewing, collecting data on customers, and built a true relationship based on trust and the understanding that you don't want to screw your neighbor. If you have a mechanic down the street, and you've lived on that street in many cases your entire life, if you need your car fixed, you really don't want to screw your mechanic over from the bill. Because if that's the only mechanic in town, well, then you're going to be without a car if your vehicle ever has an issue. So the first commercial credit agency, the Mercantile Agency, was founded in 1841. And the part that was crazy, but again, kind of makes sense once I saw it, is that it focused on things like race, marital status, age, background, and moral character. Okay? So moral character is a completely subjective term, right? That you could say that I have a good moral character and someone else has a good moral character, and then the third person who maybe in their mind has a good moral character maybe has a vice that the person, who's making the judgment of moral character doesn't like. So there's no way that you could say moral character and assign a number to it, right? Whereas, at least even with something like race, marital status, or age, that person may have no control over it, which is the reason why they made it to where those things can't be judged, or used against someone, because that's a what I guess you'd call like an immutable characteristic, right? But also, you can't assign a number to those things as well, right? So, like with moral character, I can't say you're a 9 out of 10 on the moral character scale. It's not a measurable item. And that's basically what a credit score does, is it's trying to find things that are measurable. So by the 1960s, there were more than 2,000 credit bureaus in the United States, and many of those credit bureaus were created by companies that would, were trying to give access to credit, and so they would compile that data over time. But the problem is, again, that data was in many ways subjective, depending on the person that was interviewing. But they would even have someone go like a private investigator, almost like get into people's lives, look at their vices, such as gambling or drinking habits, and as the amount of data they collected got larger, that's when I think they began to realize that they need to be able to, categorize these things into numbers, so that way they could actually simplify large amounts of data. What's the point of having 5,000, or data on 5,000 people, and trends, and understanding things like what would actually be a good or bad characteristic, such as escalating debt, like at what point do you start seeing your returns dropping. That was kind of what the merchants were looking for, to be able to actually say, okay, here are the things that we want to see consumers do, and here are the things that we don't want to see consumers do. But FICO was developed in the late 50s, and creditors were extremely hesitant to trust a model that was not focused on character assessment, so moral, basically whether or not you're a moral person. And then it was the Fair Credit Reporting Act of 1970 and Equal Credit Opportunity Act of 1974, that made it absolutely clear that personal traits will not be used in the lending process. So it was basically these two acts can be seen as the removal of things like moral judgment, when making a loan decision. So credit scores became the easiest way to scale the changes in a lending environment, and this became especially true as credit cards became more widespread. So credit scores and using those for determining whether or not someone was going to be good at repaying, that is part of the reason why institutions began relying on credit scores so heavily, was to be able to do the kind of lending that credit cards would require at such a massive scale. They had to basically simplify it, so that it didn't require so much work. And again, that's scalable businesses over large geographic areas, because when you no longer just have a town of 20,000 people and everyone knows everyone, you now have a company that's 1,000 miles away across the U.S. marketing and advertising to people in rural America, and they needed a way to be able to try and actually market to them, because otherwise it was just rolling the dice, right, if they don't have any credit history whatsoever. So, as the last slide here, why should you care about your credit score? So, as mentioned before, some institutions will use credit scores to cut off borrowers at certain thresholds. So, maintaining a good credit score is a good way to make sure that you can apply for credit in the future. Now, just because you have a good credit score does not mean that you should get the loan. All I'm saying is that having a good credit score will maintain avenues of accessing credit that maybe someone who does not have a good score would not have access to, right? Because if someone's only going to do loans for a person with a credit score over 680, doesn't matter if you have a 675, they're not going to touch you. But your credit score will dictate the interest rate at any given financial institution. So you can walk in the door of any financial institution. They may have different ranges. May have different, some credit scores for A plus tier starts at 730, some at 740. Maybe there's even ones that are super prime above A plus, like we're talking like 800 credit scores. They get a discount for. So there can be other factors that influence interest rate, like discounts or increases, maybe like mileage on the vehicle. You increase the interest rate. Maybe the loan to value on the vehicle's high, you increase the interest rate. But as long as you are applying it uniformly, that you're not giving a discount to one person for having a certain mileage, but then not giving that same discount to a person. And so, the credit score is really just there as my reference point to tell me how I'm getting the interest rate that I'm getting. Okay. But even the most sophisticated fintechs, going back to basically this last thing that I was saying, will still rely on the credit score heavily, even though they may look at the thickness of the credit profile, how many trade lines that there are, right? It can actually, some of these fintechs are actually getting sophisticated enough where they can use things like saying, okay, well, this credit report has 5 reporting revolving lines, 1 mortgage on it. This person deserves an even lower interest rate than someone who has the same exact credit score but has 1 credit card open and 6 months of on-time payments. Okay, it's happened. It's way more common than probably most people think it is. But really, it's just the consistency about how the rules are applied is the part that needs to be absolutely understood, that a credit score is the most important part of that equation, and everything after the credit score, like loan to value, mileage, things of that nature, those are just adjustments that'll be on that, and that'll vary by institution. So a good credit score, and probably the part that I would say that, I think people know, but at the same time, I don't know if they truly understand, is that a credit score, a good credit score, has the ability to save you tens or even hundreds of thousands over the course of your lifetime. So I think of this in a way where I say, okay, in your lifetime, the amount of money that you'll make is finite, right? There's a certain amount that you just won't be making over the course of your life. Not everyone is going to make, like $10 million, right? But over the course of someone's life, if they've graduated from high school, they're making, $50,000 a year. Well, you only have so many years of making $50,000 a year, to the point where you're either never going to retire, because if you don't have enough money to retire, you just have to keep working, or B, that person made sacrifices, put some of that money away, saved up enough money for retirement to where by making smart decisions, they were able to, actually live a more comfortable life. Well, when it comes to the credit score in any of these scenarios, if your interest rate is lower, the finite amount of money that you can make over the course of your life is going to be positively impacted. You get to keep more of the money that you make if your interest rate is lower, right? And we're assuming the same loan amount. Let's use a $30,000 car loan. Well, $30,000 car loan, if you're at 5.99% and another person is at 9.99%, that difference is money that person at 599 gets to keep in their pocket. And even if the terms are the same, right, they're going to be saving that money. And if you have a finite amount of money you're going to make in your life, every penny that you can keep matters, right? Whether or not you're thinking about it or not. So a good credit score leads to a good interest rate. A good interest rate leads to saving money over someone that does not have a good interest rate. And the only way that you don't have a good interest rate is by having a bad or a low credit score. Okay, so that's the end of what I have to talk about here. Be interesting to see what people have to say in the comments. Sorry if I'm rambling a bunch. I get pretty passionate about this topic, and I try to provide as many examples as possible to make it relatable. Yeah, I'm going to be working on my next videos as well. I'm going to go back to the John and Jane retirement series. But yeah, we'll be making some other stuff, and I'll be doing more screenshots, looking at a program at our work called Savvy Money. I'll be showing my account and what my credit history looks like, and using that to dispel some of the myths that exist out there in terms of the advice that a lot of financial institutions will give people, trying to explain to them how to build credit or how they can improve their situation. And in some cases, it's just flat out wrong. TikTok is the worst possible example. We've had people come in and tell us, well, that's not what I learned on TikTok. And actually then be skeptical of the advice that we're giving because they literally trust TikTok. So anyway, thanks for watching. If you made it all the way through the video, if you guys could, give me some likes and, subscribe and things like that, I'd greatly appreciate it. My goal is to try and disseminate this information out as much as possible, so that everyone has a chance to be able to, learn some factual stuff about their credit. All right. Thanks, everyone. Bye.